Welcome to the week that was. Imagine a scenario where global shipping just comes to a dead halt, inflation spikes to a 3-year high, and billions of dollars are wiped out of digital asset markets in a matter of minutes.
Yeah, it sounds like an absolute nightmare scenario.
Right. In almost any other era, that specific sequence of events triggers a prolonged, devastating market panic. Yet somehow, this time frame ended with Wall Street actually absorbing the chaos and buying the dip at absolute record
It
levels.
was genuinely a masterclass in market mechanics, and really a massive stress test for global liquidity.
Yeah.
We saw a geopolitical shock collide directly with algorithmic trading structures, and the result was, well, it was entirely nonlinear.
And that is exactly what we are navigating today. We're skipping the sensationalism, we're ignoring the headline panic, and we are looking purely at the analytical reality of the data. We want you to walk away perfectly well-informed about how global power and capital actually moved.
Yeah, we have to look past the noise.
Exactly. So let's start with the physical trigger event that set this whole machine into motion. A sudden, pretty severe disruption to global energy flow.
Right. So we saw the U.S. Central Command initiate a naval blockade on maritime traffic entering and exiting Iranian ports.
Which is huge.
It is. This effectively brought commercial transit through the Strait of Hormuz to a complete standstill.
Yeah.
And to understand the gravity of that, you really just have to look at the immediate commodity response. Brent crude oil prices violently surged past $104 per barrel.
Because that specific blockade directly threatens a massive chunk of China's import network, right?
Precisely. It threatened a 1.5 million barrel per day pipeline of energy. I mean, when you choke the global energy supply chain at a critical bottleneck like Hormuz, you instantly inject this massive risk premium into, well, every other asset class around the world.
Okay, let's unpack this. Because the crypto markets felt that physical blockade almost instantaneously, I was looking at the data, and Bitcoin's price dropped from over $74,000 down to a defense line near $70,000 in just a flash.
Just completely fell off a cliff.
Yeah, but the real carnage wasn't in the spot price. It was in the derivatives market. I saw this metric that $1.7 billion in open interest was liquidated, which wiped out hundreds of thousands of accounts.
Wait, actually, before we go further, for anyone who doesn't stare at derivative dashboards all day, what exactly is open interest? And how does 1.7 billion of it just vanish?
It's a great question because this is where the hidden leverage in the system gets exposed. So, open interest simply refers to the total number of outstanding derivative contracts.
Like futures or options?
Exactly. Contracts that haven't been settled yet. It represents all the active bets people have placed on the future price of an asset, mostly using borrowed money.
So it's essentially just the total amount of leverage sitting on the table.
You got it. And when an unexpected shock happens, like, say, oil suddenly rocketing to $104, the price of risk assets like Bitcoin drops. When it drops past a certain mathematical threshold, the exchange's automated margin engines step in.
Right, they take over. Yeah, they look at a trader's account, realize the trader doesn't have enough collateral to cover their losing bet, and they forcibly sell the position to prevent the exchange itself from taking a loss. That forced selling is a liquidation.
And when $1.7 billion of those bets are forcibly sold all at once, it obviously drives the price down even faster, which then triggers even more liquidations. It's like a cascading effect.
What's fascinating here is the absolute ruthlessness of that market architecture. The data showed that over $1.6 billion of that destruction was long positioned.
People betting the price would go up.
Right, and it wasn't just retail traders sitting at home. There was a single, massive $12.74 million swap position liquidated on the OKX exchange. That confirms that even highly sophisticated institutional-scale speculators got totally trapped.
Wow. So I kind of view it like a psychological seawall, right? The macro tsunami hits, the retail sandcastles wash away, but the institutional concrete holds firm at that $70,000 mark. But the margin engines, they do not care about your geopolitical predictions at all.
Not even a little bit. They don't care if you're a retail trader or a multi-million-dollar hedge fund betting on an early peace treaty. If you cross the threshold, the math just deletes your position.
Pure mathematical enforcement.
Exactly.
Which perfectly transitions us to the underlying economic pressures that this energy shock exacerbated. Because, I mean, a $104 barrel of oil doesn't just sit in a vacuum. The cost of energy feeds right into the plumbing of global finance. We saw the U.S. Producer Price Index, the PPI, hit a 3-year high of 4.0% year over year.
And that was driven heavily by wholesale energy costs, like Diesel fuel alone advanced 42%.
That is insane.
It is.
Yeah.
And elevated producer prices pipeline directly into elevated consumer prices, which signals that the U.S. Federal Reserve will likely have to maintain a restrictive, high-interest rate monetary policy just to fight off that inflation.
But I have to push back on the traditional economic playbook here. If U.S. inflation is running hot at 4% and the Fed is keeping borrowing costs high, why isn't the global risk market just collapsing under the weight of expensive capital?
Well, because you have to look at the other side of the globe. At the exact same time the U.S. is facing this sticky inflation, the Bank of Japan paused their interest rate hikes. And that decision left real interest rates in Japan at a negative 2.15%.
Wait, so the Bank of Japan's cheap money is secretly acting as the ultimate shock absorber for the world?
It absolutely is. A negative real interest rate means that when you account for inflation, the bank is essentially paying you to borrow money.
Wow.
Yeah, it keeps global borrowing costs bizarrely low, providing this backdoor source of liquidity even when the U.S. is tightening. But there is a second, highly specific layer to this pressure cooker, specifically in the digital asset derivatives market. Research from K33 showed that the 30-day average Bitcoin funding rate remained negative for 46 consecutive days.
Okay, again, for the listener who isn't a quantitative trader, break down negative funding rate. I know 46 days matches the absolute rock bottom of the 2022 bear market, but what is that metric actually measuring?
Sure. So in crypto, you have perpetual futures contracts. These are bets that don't have an expiration date. To keep the price of those contracts anchored to the actual physical price of Bitcoin, exchanges use what's called a funding rate.
Okay.
When everyone is feeling optimistic and betting the price will go up, those long positions have to pay a small fee to the short positions. It balances the market.
But if the rate is negative for 46 days...
It means the exact opposite is happening.
Yeah.
The market was so overwhelmingly pessimistic, so heavily skewed toward betting that the price would crash, that the short sellers were forced to pay a continuous premium to the long holders just for the privilege of keeping their downside bets open.
So millions of dollars were trapped in these synthetic short positions.
Exactly.
Ah, I see. It's like a massive game of musical chairs. You have all these traders heavily leveraged, paying high fees to bet against the asset. But what happens when the music stops and the price actually starts to go up? They all have to scramble to buy the asset to cover their shorts, but there aren't enough chairs or, liquidity to go around.
That is the perfect analogy. You have cheap fiat capital flowing in from Japan acting as fuel, and a massively over-leveraged short market acting as kindling. It basically created the perfect mathematical conditions for a coiled spring. Any piece of positive news was going to force those short sellers to buy, driving the price up explosively in what we call a short squeeze.
Here's where it gets really interesting, because that positive news finally arrived and the tension broke. We saw a diplomatic pivot. A 10-day ceasefire was struck between Israel and Lebanon, and the Strait of Hormuz was reopened by Iran. Even though the U.S. naval blockade technically remained in force on paper, the physical flow of energy resumed.
And the market's reaction was instantaneous. Brent crude oil retreated from $104 down to 98 days per barrel. And with the threat of an immediate energy shock evaporating, traditional markets responded exactly as you'd expect.
Right. Broad equities like the S&P 500 just rallied to all-time highs.
Exactly. But the crypto reaction was the real fireworks show. Because of that coiled spring you just described, Bitcoin surged. It hit an intraday peak over $78,000 before settling into a really strong $76,000 to $77,000 support range.
Yeah, and the data shows that over $350 million in short positions were completely crushed in that ensuing short squeeze. They scrambled for chairs, and the chairs just weren't there. But to me, the real story here isn't the price action. It's the underlying structural shift. Like, who is actually buying during all this volatility?
You're referring to the institutional accumulation.
Yes. While retail traders were getting liquidated and panic selling the blockade headlines, Wall Street giants were acting like blue whales, just calmly opening their mouths to swallow up all the liquidity. Initially, we saw spot ETFs experiencing outflows, but as the situation developed, U.S. spot ETFs absorbed a massive $663.9 million net inflow in a single day.
That's a staggering amount of capital.
Yeah.
And we saw the distribution channels widening significantly too. Morgan Stanley debuted their new MSBT fund, and it accumulated $103 million in just 6 days. Yeah, they accomplished this largely by undercutting competitors with a razor-thin 0.14% management fee. On top of that, Charles Schwab launched retail crypto trading for his clients. And keep in mind, Schwab oversees roughly $12 trillion in total managed assets.
12 trillion. That's hard to even wrap your head around. And I saw that MicroStrategy was buying the dip again, too. How much did they actually lock up this time?
They acquired another 17,585 Bitcoin. That brings their corporate treasury to an astounding 780,897 BTC.
Which is almost $54 billion sitting in a single corporate reserve. So what is the actual mechanical impact of Wall Street and corporations buying at this scale?
If we connect this to the bigger picture, what we are witnessing is the permanent removal of active float from the secondary market.
Active float.
Yeah, active float is the supply of an asset that is readily available to be traded on exchanges. When an ETF fiduciary or a corporate treasury like MicroStrategy buys Bitcoin, they aren't day trading it. They pull it off the exchange and move it into cold storage custody, deep offline vaults.
So they're effectively creating a new permanent structural floor for the asset's price. The supply is basically going down a one-way street.
Precisely. Every time leverage flushes out the retail speculators, institutions absorb the loose supply, and that supply does not come back to the open market easily.
It's fascinating. But while American Wall Street institutions are hoarding the asset, we are seeing sovereign nations and global regulators display these wildly contradictory behaviors. It really exposes the growing pains of global adoption. Take the Kingdom of Bhutan, for example. We saw reports that they unexpectedly liquidated 70% of their national Bitcoin reserves, transferring millions to exchanges.
Yeah, they moved a massive portion out of their primary vaults, reducing their total national reserve from about 13,000 down to just under 4,000 Bitcoin.
And the analysis suggests their state-run hydroelectric mining strategies are facing viability issues because of the post-halving network economics. Break down that phrase for us. Why does a mathematical update force a sovereign country to sell off its treasury?
It comes down to the brutal reality of the network's design. Every 4 years, the Bitcoin network undergoes a halving, which means the amount of newly created Bitcoin rewarded to miners for securing the network is cut perfectly in half.
Right.
If your energy costs to run those computers stay the same, but your revenue is suddenly cut in half, your profit margins just vanish overnight.
So a small sovereign nation like Bhutan, even with cheap hydroelectric power, suddenly can't pay the bills just to keep the machines running. Does that mean the future of mining is entirely corporate?
It certainly looks that way. They face immense mathematical difficulty competing against publicly traded corporate mining giants. A corporate miner like Bitdeer, for instance, can integrate AI cloud computing to monetize their extra data center capacity.
Oh, that makes sense.
And they have access to massive traditional debt markets to fund their operations. They have a financial floor that a sovereign nation running a standalone mining farm simply doesn't have. The industrialization of the network heavily favors corporate consolidation over smaller sovereign actors.
But the sovereign contradictions don't stop with Bhutan. Look at South Korea. They dealt with a massive operational failure at the Bitham exchange. An employee executing a promotional giveaway accidentally input the payment unit as Bitcoin instead of Korean won.
Yeah, that was a disaster.
They distributed 620,000 phantom Bitcoin to retail accounts. That is a $43 billion error. How does an exchange even allow that to happen?
Because they utilized an asynchronous ledger protocol.
Let's translate that.
Sure. Most centralized crypto exchanges don't actually process every single user trade on the public blockchain because it would be too slow and way too expensive. Instead, they use a traditional centralized internal database, like a standard SQL server, to track who owns what. They only reconcile that internal database with the actual immutable blockchain once a day or asynchronously.
Ah, so the employee essentially just typed the wrong number into a private spreadsheet and the system believed it was real.
Exactly. It allowed the creation of phantom liquidity that instantly crashed the local trading pair before the actual blockchain could even verify that those 620,000 Bitcoins didn't actually exist in the exchange's wallets.
That is terrifying. So the Bank of Korea naturally steps in and demands traditional equity-style circuit breakers and dual verification systems for crypto exchanges. They are trying to protect the public from centralized incompetence. But simultaneously, and this is the incredible irony, the South Korean Ministry of Economy and Finance announces they are piloting blockchain-based deposit tokens for their own government business expenses.
Right.
They want to use smart contracts to bypass Visa and MasterCard fees for taxpayer capital.
It is the beautiful contradiction of the modern sovereign state. They look at the centralized exchange and say, you're private, Internal ledgers are broken and dangerous. We need to enforce traditional circuit breakers. But then they look at the underlying decentralized blockchain technology and realize, wait, this immutable transparent ledger is actually mathematically superior to our legacy banking systems. Let's use it to manage our own tax dollars.
Yeah, they fear the incompetence of the middleman, but they trust the mathematics of the protocol.
Yeah, exactly.
And we are seeing aggressive regulatory posturing in the West, too. The UK's Financial Conduct Authority laid down a hard mandate requiring all cryptographic service providers to be fully authorized by 2027, and they explicitly warned there will be zero insurance for lost deposits. Meanwhile, in the US, the Treasury is pushing for the passage of the Clarity Act. You literally have the Treasury Secretary warning that regulatory stagnation in America is causing a brain drain of engineering talent to places like Singapore and Abu Dhabi.
Regulators are finally waking up to the fact that capital and cryptographic talent are highly mobile. If you enforce ambiguity and regulate by enforcement, the industry simply packs up and migrates to jurisdictions that actually offer clear rules.
But honestly, the regulators feel entirely justified in their crackdowns when you look at the structural chaos happening at the protocol layer. Which brings us squarely into the world of decentralized finance, or DeFi. We saw the World Liberty Financial Protocol suffer a massive breakdown.
Yeah, that was a big one.
Blockchain forensics proved that their administrators held centralized authority to freeze tokens without any decentralized governance vote. Once that was exposed, the token plummeted 76%, their stablecoin broke its dollar peg, and Justin Sun is out there alleging fraud.
It completely exposed the illusion of decentralization that a lot of these projects operate under. I mean, they market themselves as community-run, but there's a backdoor.
Right. And on the exact opposite side of the spectrum, you have Circle, the issuer of the USDC stablecoin, facing a class action lawsuit. Why? Because they didn't use a backdoor. They refused to freeze $230 million in stolen USDC during the Drift protocol hack. The Lazarus Group hackers moved the stolen funds, and the plaintiffs are arguing Circle should have unilaterally acted as a police force and frozen the assets. Circle's defense is that they only freeze funds when given a formal law enforcement order.
Right. They are attempting to act as a neutral protocol layer, much like the internet itself, rather than a global arbiter of justice.
So what does this all mean? I have to challenge the whole premise of DeFi here. It feels deeply hypocritical. World Liberty Financial claims to be decentralized, but secretly has a centralized kill switch. Circle claims to be a neutral protocol, refuses to use their kill switch, and gets sued by users for not acting like a traditional bank that reverses fraudulent charges. Is DeFi really a financial revolution, or is it just traditional finance with terrible customer service?
This raises an important question about the maturity of the infrastructure we are actually building.
Yeah.
You're pointing out the messy, awkward middle ground where early DeFi projects tried to have it both ways. They wanted the hype of decentralization, but the safety nets of traditional finance. However, the resolution to this exact paradox actually emerged in the data this week as well.
Oh, really?
Yeah. A company called VerifiedX launched something called the Prism Privacy Layer, which utilizes zero-knowledge proofs.
Okay, zero-knowledge proofs is a term thrown around constantly. Explain the mechanism behind it in plain English and why it solves this paradox.
Sure. Think of a zero-knowledge proof like a bouncer at a club. Normally, to prove you are over 21, you have to hand the bouncer your ID, which means revealing your exact birth date, your home address, and your full name.
Right.
A zero-knowledge proof is a cryptographic mechanism that allows you to mathematically prove to the bouncer that you are over 21 without ever showing them your ID or revealing a single piece of underlying data. You prove this statement is true with zero knowledge shared about the details.
So how does VerifiedX apply that bouncer logic to institutional finance?
Well, VerifiedX integrated viewing keys into this privacy layer. It allows a massive institutional fiduciary to transact completely privately on a public blockchain. They can move hundreds of millions of dollars without anyone seeing the wallet addresses or the amounts, protecting their proprietary trading strategies from competitors.
But what happens when the government shows up demanding an audit?
That's where the viewing key comes in. If a regulator or an anti-money laundering auditor comes knocking, the institution can simply hand over their cryptographic viewing key. That key acts as a mathematical guarantee, providing perfect, verified compliance to the regulator without exposing the data to the public internet.
Wow. So it completely bridges the gap. Institutions get the absolute privacy they require to operate competitively, and regulators get the total transparency they need to prevent illicit finance. It solves the DeFi paradox.
Precisely. It is the missing link for massive institutional adoption.
Which perfectly wraps up our core lesson for this deep dive. If you're looking for the ultimate takeaway from the past several days, it's that the digital asset market has officially graduated. It is no longer an isolated sandbox for retail speculation. Think about what we just covered. It absorbed a massive physical energy shock in the Middle East. It completely ignored a 4.0% sticky inflation print. It washed out the over-leveraged retail speculators with absolute algorithmic precision. And it ended the cycle with Wall Street wirehouses and sovereign nations quietly locking up the underlying supply in cold storage.
And I want to leave you with a final thought to ponder, building right on that graduation. We just saw the debut of zero-knowledge proofs that allow for perfectly hidden yet fully compliant transactions for massive institutions. If nation-states and multi-trillion-dollar asset managers now have the technological capability to move capital across public blockchains without anyone on the outside seeing the amounts of the addresses, how will we ever truly know who is accumulating power during the next global geopolitical crisis?
The diagnostic X-ray machine isn't just broken, it's being intentionally encrypted. But the financial engine underneath is running faster and quieter than ever before. Thanks for joining us for the week that was. We'll see you next time.